Hey everyone, it's Friday, June 21st. It's first day of summer and today's the summer solstice, so we're going to get the longest day of the year. On that note, before we head into the weekend, we're going to go through our latest video. As we've been suggesting, before you watch this thing, go to our website and maybe you want to pull up our markets insights section, our S&P 500 running chart. It's a chart with buy, sell, hold kind of indicators. And as you look at that while I'm talking, you may be able to follow where we are in terms of our positioning and how we're viewing things. Second of all, we put this content out just as a courtesy to everyday investors. We've gotten really good feedback on it, but do us a favor. If we're going to put the time and effort in, we want to reach as many people as we can. So if you could do us a favor and like it, subscribe to our channel on YouTube, that'll help the algorithm get where it needs to go. So we're going to talk about three things. We're going to give you a market update, what's going on, pretty exciting times. We're going to talk about our economic and monetary outlook. As we always do, we'll touch base on what the Fed is doing and where we think they're going. And lastly, we'll talk about how we're playing this market and how we're thinking about that. So market update, we're halfway through the year. In another week or so, we're going to be halfway through the year officially. The S&P 500 is up 15%. The NASDAQ's up a little over 17%, about 17.4 right now. We're at 5,465 on the S&P 500. We're above our year-end target of 5,250. We had a 240 S&P 500. That was Wall Street consensus for earnings for the 500 S&P companies, $245 a share, $40 a share. They've now upped that to 245. But even at that 245 level, we are still trading at 23 times this year's earnings. We're trading at 22 and change times the following 12 months earnings. And we're trading at 19. It takes a couple of years out, 19.7 times out 2 years earnings. So why is the market doing that? Well, either one, it's getting frothy and overpriced, and at that case, it'll pull back here in the coming months. But if that's not the case, then Wall Street could be wrong, and maybe they underestimated corporate earnings, and the market is sniffing it out. The third reason it may be trading higher is that the market is telling us that the bets are that the Fed is going to cut rates later this year, and stock valuations could get elevated. It's okay to be elevated in a low interest rate environment. So if we're heading back toward a low interest rate environment, then stocks could advance. So that's the update on that. In terms of our economic and monetary outlook, look, the Fed is getting some data that's saying to itself the economy is slowing down. They have a dual mandate. Their job is to get maximum employment and keep inflation under control. So the last couple of weeks of inflation data has been coming in lighter than expected. So inflation is taming. CPI and PPI have come in lighter than expected, but they're using primarily around housing data, particularly rents. Rents are in the CPI report come in at a 3-month lag, and if you use real-time data, today's data, CPI is under 2%. So, and PPI came in like 1/10 under expectations. So inflation picture is better than saying the Fed could go and lower rates here and be justified to do so. More importantly is on the employment roll. We got numbers a couple of weeks ago for the May employment report. Unemployment for the first time in over 2 years hit 4%. We were at 3.9 the period before, and unemployment's kind of been grinding off these real historical lows for the past couple of months. So at 4%, you get to 4.1, 4.2, the Fed can absolutely be justified in lowering rates. So they've got that in lower rates favor. Initial jobless claims is another really important figure. It comes out every week. It's how many people are applying for unemployment benefits. And the sweet spot, you want to see 200,000 to 240,000 people per week. It's a weekly number filing for unemployment benefits. If it gets above 240, that's too many people. It's starting to accelerate that more and more people are losing their jobs. If we get under 200,000, it means less people are unemployed. And the Fed kind of really wants to get on the right side of that. Well, this week's number was 249,000. It's the highest number in quite a while. So this is all getting the Fed's attention, and it should be getting the Fed nervous because, just like once you let inflation out there, it's really hard to retain back in. Once you get inflation going down or the economy going down, the momentum really picks up. It's very hard to turn around. So to do a soft landing, you need to be anticipatory. So we hope that they are. How we're playing it, lastly. I get asked all the time, look, we've had a great run here. We've made a lot of money. Are we taking profits? Are we selling? And, my answer is usually we're not selling just because the market went up. I mean, that's why we're in this game, is to make money when the market goes up. We go through a lot of time to get periods like we're in right now. They're rare, but we've seen them quite a bit. And the idea is being prepared for them, we'll know when to trim back a little bit. And it doesn't mean markets can't go down. Markets go down and certainly will go down all the time. And as an investor, you've got to train yourself to not really kind of get too concerned when that happens. But the main reason we don't sell, first, we're long-term investors. We don't want to just ride this wave and then a correction. We want to ride the next decades, waves and corrections and waves and corrections, and constantly rebalancing, constantly finding new investments, new themes. We're never done. It's like surfing. You get a set of, at surfing, you get 7 to 12 waves, and then and they're beautiful, gorgeous waves, and then you go sit on your board for a few minutes while you wait for the next set to roll in. Stock markets are the same way. They're not going anywhere. We're in a great set. The set will come to a pause. We're going to sit around. We're going to wait for the next set to come in. But the main reason we don't really take profits into this thing is we are guaranteeing our investors, our clients, that they're going to take about a 30% hit guaranteed by the time they pay federal capital gains at 20%, and whatever your state taxes are of, in New Jersey here, it's between 6 and 10, over 10%. So if you're in the highest bracket, you're going to, right off the bat, we're going to penalize someone by a 30% cut. We need the market to go down almost 30% just to break even that the sale was the right trade. And I'm just not going to do that. We run very tax efficient money here. And it's one of the things, who wants to give away money if we don't need to? So an example of long-term investing is, we always look at our top 13 stocks. We post them online often. This is public information. It's on our 13F that gets filed every quarter. You get it a month and a half after the quarter end, but anyone can go into any of these 13F trackers and see what we're buying and selling. But truth be told, our number one holdings are going to be, number one, the S&P 500 index fund. VOO is the ticker. It's the Vanguard S&P. It's got a 3 basis point V, next to nothing. Our next one is going to be the NASDAQ 100, right? We're going to own the Vanguard Total Stock Index, although our NVIDIA position has recently broken above our total stock market position. But our top 10 holdings, I'll rip through them. NVIDIA, Apple, Microsoft, Google, those are the top 4. We get some non-tech next: MasterCard, JP Morgan, Costco, Eli Lilly, Meta, Facebook, Home Depot, Berkshire Hathaway, Danaher, and Amazon. Okay. Now, while a lot of this is in tech, there's some great stocks underneath not in tech. Eli Lilly is up 52% year to date. It's up 142% 2023 in the first half of 2024. So when I added these up, we just did this, the team just did this a few minutes ago. When we add this up, if you bought an equal amount in each of our top 13 stocks, year to date, you are up 31.66%, and the S&P 500 is up 14.74. So we're doubling whatever the return on the S&P 500 is. And by the way, these 13 companies, they represent 15% of our entire practice in terms of assets under management, which may not sound like a lot, but in 13 stocks it is. We have hundreds of millions of dollars in treasury bills and bonds and mutual funds and ETFs. And that's all by appreciation. We've owned a lot of these things for well over a decade. If you held this position from 2023, all of 2023 and the first half of 2024, our portfolio is up 141.92%. The S&P only up 42%. So we're outperforming by 1,000 basis points or 100 percentage points. Strong performance, and it's not hard to find these companies, right? They're right under our nose. They're in products we use every day. They're incredibly well run. And they're certainly not the next hot thing like some of these tech stocks. I mean, Berkshire Hathaway is one of the oldest stocks in the S&P 500. If you're looking to build a portfolio, it's not a bad place to start. If you don't have exposure to these names that have been running for many, many years, you got to revisit your strategy. Because like I said, these aren't hard to find. They are hard to hold and not take profits, because you're going to make most of your money over the next decade or 15 years. And this isn't all we buy. These were bought years ago. We are now laying the seeds for what we're going to be talking about in 5 and 7 and 10 years. And again, not recommendations to buy or sell. Can't even say that we're buying them right now, but you can always find them in our 13F anyway, so it's public information. But, we're taking positions in Ferrari right now. The ticker's RACE, R-A-C-E. We're buying Novo Nordisk, which makes Ozempic, which competes with Lilly's drug, right? We want to own both of those companies. We're buying Kinsale, which is a specialty insurance companies. We want to have positions in Palantir. Broadcom, a great big cap company. It should be in the top 10. Why I didn't buy that for years is beyond me. ARM Holdings, Marvell, Dell, Lam Research, positions we've been establishing in. But that's tech, but some of it isn't tech. So again, you can find this stuff on our 13F. I try to be transparent with it, but like I said, if you can help us get the algorithms going, we can help more people get on with their investing. So that's it. That's the wrap for today. I wish everyone a great longest day of the year and have a great weekend, and we'll talk to you really soon. Bye.